pleasure.
Well, we've been hearing that chances are that we're going to see May retail sales numbers disappoint, bearing in mind that we did see a high base effect come into play in April. Consensus is a move to 6.3% from 9.8% year on year. Are you in line with consensus?
The Nedbank numbers, and that's your best barometer because it's the economics guys who work these things out.
Mm-hmm.
Nedbank's numbers are below consensus, and I checked that out with them as recently as about an hour or so ago. When I look at the trading updates, and quite a few of the big retailers with June year ends have just come out with numbers, and prior to that, one of the very bigger retailers, the Massmart Group, hosted a site visit in the middle of May. So we can, we've obviously got their numbers up to May, and then we've got the numbers for the additional 7 or 8 weeks to take you through to the end of June. It's clear that in the month of May and the month of June, the tempo, the momentum of retail sales has slowed considerably. Mm-hmm. Now, I don't think anybody was ever able to work out precisely what the impact of the World Cup was. Some retailers, I mean Massmart, were talking 200 to 300 million. It's clear that the 200 to 300 million was somewhat on the low side. I think it was more broadly based across more of their operating divisions, and in areas, sub areas within those operating divisions that they didn't even consider, they didn't even think about it at the time. And I'm not criticizing them for that. It's just the kind of thing you don't kind of consider the impact on the hospitality industry of the World Cup. And hospitality spreads through to consumers as well. It's not just people going out to restaurants. Mm-hmm. It's call it home entertainment. And I think that started spreading through the food retail, the retail food chains through the month of May, and certainly through the month of June. And of course, we're only going to see those June figures in about a month's time. Yeah. So I would guess that on the balance of probabilities, the numbers are going to disappoint. They're going to come in, let's say, rather lower than expectation rather than higher than expectation. Mm-hmm. And I would say the World Cup effect is in there, but we don't know to what extent the fears of electricity hikes and the fears associated with huge price increases for fuel and what have you impacted on consumers' spending propensity exclusive of the World Cup impact.
And in which sectors, and that's certainly coming to bear right now. Speaking to traders at the desk, I mean, they're highlighting that a distinction needs to be made between the various retailers right now. We've seen share prices continue to surge higher, and a lot of them focusing on the lower end retailers more so than anything else, given that we've seen demographic changes in the country that will impact growth more so moving forward.
Yeah, well, that is another issue. That is, once again, yet another issue that's got to play itself out. At the end of the day, my kind of simplistic research says it's a kind of bottom-up approach. Let's start at the bottom. The bottom is consumers have X amount of money to spend. That you can calculate quite reasonably accurately, because it's a function. I mean, total amount of spendable money is equal to the number of people employed, obviously multiplied by the amount of money they earn. Mm-hmm. We know that the employment number, the first number, is down. We know that wages are higher, and net, there is more money to spend. But the next part of the equation is, and I always refer to the old, the Maslow hierarchy, let's talk about immediate needs. The first thing is you want to put food on the table, and of course you want to have housing, and you want your utilities, you want your electricity, and what have you. Mm-hmm. Only once you've deducted those items do we have, call it a residual amount, a residual component. That's what goes into semi-durables, apparel and furniture, what have you. Now, food inflation in December last year was 0 or below 0. It's now the run rate is running at about 3% and rising. So you can see that the impact of food inflation is going to be apparent in the numbers. Yeah. And you probably saw it in the ShopRite numbers earlier this week. So more money is going on to food. More money is going to utilities because you've had the electricity hikes. You've had fuel increases. You had a drop this month, but if I just look at the newspaper this morning, I can see that in all probability there's going to be a hike next month, probably equal to the amount of the drop at the beginning of July. So you're back to square one again. So you've got all these factors that you're deducting, and what's left goes into the goes into the so-called discretionary spend. The bottom line, the bottom line is that there would appear to be some kind of potentially disconnect between the reality and what the stock market would like to believe.
But then we've got a player like Truworths that really adds a spanner to the works. It had
it wasn't that great. Second half was significantly lower than half one. Half one they were up 15. Half two they were up about 10 or 11. It slowed down considerably in half two. You can't look at the year as a whole. You've got to look at the two halves to see what the trend is. The trend was definitely much slower. Have a look at Woolworths Food. Woolworths Apparel did phenomenally in half two, the period, same period as Truworths, January to June. At the end of the day, apparel, you know, we start off by saying we got X amount of money to spend, but then consumers' choice, their decision-making process, ultimately boils down to the product, the merchandise, the fashion interpretation. Woolworths read the market far better, much better.
That's certainly something that stands out at the desk. We've had commentators put Woolworths in the spotlight, saying that, you know, this business is being run pretty well at this stage of the game. They've relooked their operations and we're seeing a turnaround.
They got the fashion right. And the processes they put in place would appear to be working. But on the food side, there was once again a big slowdown between half one and half two. And why? I'm worried we're going back to what we saw 2-3 years ago. When consumers find themselves in a bit of a crunch, they trade down. And what happened to Woolworths when we had that situation 2-3 years ago, 2008? Woolworths' food growth slowed far more than its competitors because consumers were trading down. There is evidence, in my opinion, that started happening in the last 6 months. So once again, we're seeing that playing out in the marketplace.
Implications then for a player like, let's put Shoprite on the table here, you know, because it's within an environment we've got to bear in mind where you've got a giant like Walmart entering the fray and, of course, that Walmart effect taking hold.
Well, the Walmart effect is a huge debate. My view, having looked at Walmart's first joint advertising salvo in one of the big Sunday newspapers right at the end of June, about a month ago, I actually thought it was a little bit disappointing. I would have thought that the offers were going to be a lot better than what they were.
So you were expecting more for the consumer?
To me, there was actually absolutely nothing in the so-called discounting that got me excited whatsoever. They're going to have to do a lot more to entice consumers. On the food side, obviously Cambridge wants to make an impact and will make an impact. But my own research is telling me, I think the market can accommodate Cambridge quite easily without really impacting materially on the competitors. Certainly in terms of rolling out space, the market can accommodate it. Where there may be some turbulence is obviously in competition for space. Rentals are going to go up, and that obviously has an impact on profitability. And obviously, in order to win a market share, there may be some, call it, additional discounting. But I don't believe, having thought through it, I actually don't believe it's going to have any material impact on Shoprite whatsoever. What's going to benefit Shoprite going forward is the down trading, number one, and number two, rising food inflation, because up to probably about 8, 9, even 10% food inflation. The impacts on volumes from my research shows that it's quite minimal. The market can accommodate it. The moment you go over that trigger, the increased inflation lops off from the volumes. Is it something
that Pick n Pay potentially risks missing the boat on?
Well, they've got so many other things to get right. First, if those things were right at this moment, they wouldn't be missing the boat at all, because they're also there with Boxer in particular to capture the down trading. They're also there to capture down trading, potential down trading from Woolworths. But there are so many other things they have to deal with right now, and potential turbulence from the planned retrenchment, that, you know, one kind of gets the feeling they may have to divert their attention to other things rather than trading at this particular point.